We're about 15 minutes away from the end of the trading day. Equities are under pressure. Bonds are also selling off. This ahead of the Fed's rate decision tomorrow at 2 p.m. Eastern time, where investors will look, as always, for any hints about the next rate cut. Blake Gwinn, head of U.S. rate strategy at RBC Capital Markets, joins us. We walked into this year expecting maybe 6, and now investors wonder, are we even going to get 1? What do you think the setup is like? What do you expect Jerome Powell to say about rate cut expectations?
I mean, what is there really left for him to say? We heard from him 2 weeks ago, and I think he was very clear in kind of shifting or backing away from this kind of bump in the road narrative they've been using to describe inflation, to describe the inflation in Q1 so far. That capped off, I think, a shift we'd already seen from dovish and centrist members of the FOMC. Collins, Jefferson, Daly, we've heard from many of them already, even prior to Powell, where they made it evident that there was this kind of shift after the March CPI. So I think he largely repeats the tone that we heard. I don't think there's been enough new data in the 2 weeks since we've heard from him to really kind of shift that tone. So I expect him to kind of drive home this message that they don't have the confidence right now to really be, talking in any concrete way about cuts. The way I see it is, they want to see consecutive good inflation prints. They were almost to that bar in December and into January, as you mentioned. And then I think the Q1 data, the Q1 inflation data basically wiped that counter back to 0. So they're starting back at square one right now.
And then how do you think about forecasting that path? Because it seems like March was a pivot point, not just for the Fed, but for yourself as well. You have now a rate cut not penciled in until the end of the year. Do you expect kind of a rearing of inflation to poke back up again?
It's not that, we've completely rewritten our longer run outlook on inflation. Certainly the Q1 data is problematic, but I think more what led to that call change is really how the narrative kind of shifted. I think, again, this idea that they want to see continued consecutive prints, to have that confidence that inflation is kind of heading back down, towards their target. I think when they've kind of, wiped that slate clean with, this Q1 data, it starts to make June look very, very difficult. It starts to make July look very, very difficult. If you lose those first 2 meetings due to the problematic inflation narrative and waiting to get that buildup of good inflation prints, that basically takes you into the election cycle. The U.S. election in November, we've got, the September FOMC meeting and the November FOMC meeting, which are in very close proximity to that election. And I think for me, whereas I would have been fine, I think with the Fed continuing a corrective cutting process that was already in place at the time of that election, I think it's very difficult for them to start that process, in very close proximity to the U.S. election. I think it just invites a lot of criticisms, a lot of threats to independence, from the public, from the press, from Congress. It's not really worth it. These are preventative cuts. They're nice to have. They're not need to have. It's not going to be the make or break between a hard landing or soft landing. So I'm not sure why they would go in September, November and invite that potential criticism. So that basically takes us to December, which is now our call.
Okay, so I wonder then if the Fed might become a bit of an outlier holding rates where other countries start to cut. I mean, here in Canada, we just got a read of GDP that, signaled that there was no expansion for the month of March. You have a slowdown definitely in Europe. At the same time that inflation, especially core inflation, is coming down, might we see rate cuts elsewhere first?
Yeah, I think that's generally been the call. And I at least when I talk to investors, I think what's become more of a theme, for trading, more so than outright direction of duration, the outright direction of the curve in the U.S., I think people really are focused on these kind of cross-market themes. And it's really a question of how much can the U.S. diverge from these other countries before, other countries are kind of forced into following the Fed, at least to some degree, to make sure they, don't get these big reactions through the FX channel. The rate differentials will drive currency rates and, could, start to have adverse effects. And so I think, the other countries have to start deciding how much of that divergence they would allow. And that's a big theme with investors right now, I think, so far. Most people are comfortable with continuing to trade a widening divergence between the U.S. and other central banks. our own house view from my European colleagues on the strategy side, they think that divergence has probably gone a bit too far. But I will say that the underlying mechanics in the U.S. are just different than they are elsewhere in the world right now. We're talking about corrective insurance type of cuts. And the way I tend to think about those is you're buying protection against downside growth and labor risks with some increase in upside inflation risk. And right now, those insurance cuts are very expensive. We don't have a whole lot of downside that we need to protect against. And in the meantime, with all of this inflation pressure we've seen in Q1, buying that insurance via cuts is very costly in terms of potential upside inflation risk. So it just doesn't make sense for the Fed. Whereas I think if you look at some of the underlying dynamics elsewhere, it does make sense to deliver some of those insurance cuts. So, absolutely, I think that divergence can happen. It's just a question of how far will that go before central banks have to respond due to the currency mechanics.